Hey everyone, Joel here from Solace Financial. March was one of the most volatile months we've seen in years, with geopolitics, inflation, and interest rates all colliding at once. Let's break down what's happened and what it means for investors. The big story: the Iran conflict and oil shock. The month was dominated by the escalation in the US-Israeli conflict with Iran. One line from a report sums it up quite well. Iran retaliated by effectively closing the Strait of Hormuz, through which roughly 20% of the world's seaborne oil had transited. That partial closure triggered a major global supply shock. Oil prices surged above $100 a barrel, the highest level since 2022. That single event reshaped inflation expectations, interest rate forecasts, and equity markets worldwide. How markets reacted? Well, for equities, it was a risk-off month. Australian shares fell by 7.3%, hit by both global energy shock and the RBA's second consecutive rate hike. Tech and real estate were both the hardest hit, and bond yields jumped above 5%. Small cap stocks struggled with higher funding costs and weaker growth expectations. Globally, the S&P 500 dropped 5%, the Nasdaq fell more than 7% as rising yields pressured growth stocks. Japan saw the sharpest correction, with the Nikkei falling 13.2%, its worst month since the GFC, due to its heavy reliance on Middle Eastern oil. For commodities, oil surged 53.6% in March alone. Gold fell 12%, largely due to forced selling as investors met margin calls. Iron ore rose 8.8%, supported by supply disruptions. For bond markets and interest rates, bond markets were hammered as inflation expectations spiked. The US 10-year yields jumped to 4.32%. The Australian 10-year yield surged above 5%, the highest since 2011. The RBA delivered a 25 basis point hike, taking the cash rate to 4.1%, with Governor Michelle Bullock warning that inflation was already high even before the conflict. One line from the report captures the mood. Economists warned that CPI could escalate towards 4.5% in the near term. Markets are now pricing in for the possibility of another RBA rate hike in May. So what's the economic backdrop? The combination of higher oil prices and slowing growth has raised the risk of stagflation. Higher inflation at the same time economic activity softens. The conflict has also disrupted other critical outputs: urea, which is affecting global food production, aluminium, and helium, which is used for semiconductors and medical imaging. It isn't just an oil story, it's a broader supply chain shock. So what does this mean for investors? Well, looking ahead, everything now hinges on this conflict as it evolves. If tensions ease, we could see a strong relief, especially in tech. If tensions continue, expect higher inflation, slower growth, and ongoing volatility. That said, it's important to zoom out. The medium-term outlook remains supported by resilient corporate earnings, continued investment in AI, and productivity. The key takeaways right now is simple: diversification and adaptability are critical in this environment. So that's your March 2026 snapshot. If you want to understand how these shifts affect your personal strategy or portfolio, reach out. We're here to help you navigate with clarity and confidence. Until next time, we'll be watching, and we'll see you next month.